Alright, so again, today is Wednesday, July 10th. And I'm going to, let me cancel this. I'm going to run through my current positions, why they are open, and what I plan to do with them. So ALLK, on that one, I sold a call, and that one, as you can see, is starting to become profitable. Nice little $90 profit on that one. And why did I sell the call on ALLK? That is because ALLK, notes, that's from the screener. So the implied volatility was extremely high, and these showed up on the screener a few days ago. So implied volatility tends to mean revert. It also had a few bearish symbols or indications, which made me decide to sell the call rather than sell the put. So I sold this a few days ago. Oh, and look what happened. ALLK, I sold the call, and look what happened. Unbelievable. Wow, I wasn't expected to fall like that. So, see, the day I sold ALLK was July 8th, so that was Monday, and implied volatility had been peaking, as you can see. It still is, all right, it still is, but once implied volatility starts to level off, then it's really going to increase in value. So right now, the increase in value has just been because of the drop in price since Monday. So this is where I sold, and it was I sold at the 20 delta. So ALLK, I sold the 45 call, and that's expiring in September. So I took in a pretty decent credit. I've already made $90, and that means, you know, it's only a fifth of the way before it's 100% profitable. So, you know, once it gets to 100% profitability, 5 times 9 is 450. So this is on the way to a pretty nice profit. It would have to go up right now about 7 points, and implied volatility also would have to stay high. But again, looking at implied volatility, that's the other shoe that we're waiting to drop. RSI is quite oversold now, but implied volatility so high right here. This might actually be a good time to sell a put or buy a call. So maybe that's, well, I don't want to sell, yeah, actually selling a put right here would be a good thing because it's peaking. The call is going to gain in value, the short call, I mean, is going to gain in profitability as implied volatility starts to dissipate. So maybe what I want to do is sell a 20 delta put and take advantage of how oversold ALLK is. And let's go out just one month. So we'll go right around here is, you know, where we want to sell. Sell this one. And we'll make it a little optimistic. Have that on the books right now. and LGF Lions Gate. So that was another one over here, Lions Gate. So Lions Gate was another one from that strainer, 80% historical IV mark above 10. So we knew that the historical volatility is generally lower than what the implied volatility is right now. So we entered that also on Monday. So that's when we entered it. It was coming from an overbought position, so I should have sold a call. Let's make sure that's what I did. Implied volatility is peaking. As you can see, it's already started to go down, so that's why we're profitable. It went down. It is on its way back up a little bit, but hopefully I sold the call because this has two bearish factors right off the bat. The span B is above the span A. The Kijun is above the Tenkan, and it's but it is trading above the Tenkan. That's a little bullish. However, we have two overwhelming bearish traits. The span B is over the span A. The Kijun is over the Tenkan. Not to mention the fact that it was overbought. So those three bullish indicators should have made me sell the call. Good, I sold the call, sold two calls. That means I probably laddered them in. Let me make sure that I did ladder them in, so I got more credit than I would have if I just sold one. Yep, laddered them in, right? So I sold one at 0.3, sold one at 0.35. If I would have just sold both at 0.3, then it would have been too conservative. But since two out of two orders filled at the 0.3 and 0.35, that means I still was too conservative. I like it when only 50% of my limit orders fill. That shows that I wasn't too conservative because two of the orders filled, and I wasn't too optimistic, in which zero of the orders would have filled. So I got some, and I got the best price I could have gotten because the fact that and again, this is talking about ideal situation. Ideally, when only like half of my orders filled because they're all laddered upwards, that means I know that I got all the strike prices that were reasonable. And just to recap again, so it's clear, the reason I like having only partial orders filled, not all of them, is it shows that I wasn't too realistic nor too optimistic. I hope that makes sense. It's an important concept because if you get all of your orders filled, it's just like negotiation. If they accept your first offer, then you didn't ask enough. All right, let's look at marker MRKR. That's another one that I laddered in. You can see it 3.5 and 4.1 MRKR, and that is profitable. And I sold two calls. And the reason I did marker MRKR was because RSI was overbought, oversold, and the IV was at the 80th percentile, so it's only been higher 20% of the time within the last year. Marker was very overbought, and I said put, but I meant to say put. I purchased a put instead of sold a call because implied volatility was low, and I could tell that implied volatility had more room to go up than down. So that's how I made the decision to buy an option, which is pretty rare for me, rather than sell. And looks like it is working because MRKR is 22% profitable. I like that. Of course, that was a laddered entry. I bought it at two strike prices, laddered down. I probably could have been more optimistic because both my orders filled, 2 out of 2, 100% of my orders filled. I would have liked to have seen only 2 out of 4 orders filled. That way I know I got as much as I had asked for. If I had asked for good, better, best, and too much. So the good and better filled, the best and the too much did not. So my expectations were right around the max I could have asked for. Again, that would be a best case scenario. In this case, it was just 2 of the orders. I did sell them MRKR. You can see I bought them for a discount of where they are now. I bought one at 4.1, and right now it's worth 4.65. I bought the second one at 3.5, which was, a very optimistic limit that I was hoping would be triggered, and it was. But if I was feeling, a little more confident, I would have put in 2 more orders, laddered down even more. So I would have put in another limit order at 3, and then a 4th limit order at maybe 2.5. And those probably wouldn't have filled, but at least I would have known that I scooped up as many of the opportunities that presented themselves. Keep in mind, it only has to hit that price for a split second for it to fill. Take advantage of the fact that there's high frequency traders out there, and I could have used that to my advantage. All right, next. And let's look at when this is going to expire. So I bought an in the money put. It's still in the money, and it's expiring in October. And right now the market price is at 4.65. This is increasing in value. It's about a fifth of the way to 100% profitability. So figured if it keeps going all the way to 100%, that could be close to $850. Right now it's at $170. So, maybe I'll put in a limit order when it hits around 30% profitability. It'd be a little conservative. Get 30% of something rather than wait for 100% and risk getting 100% of nothing if this does rally. So MRKR, again, it was quite overbought. RSI still overbought, but look at this. Stochastic starting to show a sign that it's headed downwards, and today the market was up. So implied volatility is down, going down. So that will erode some of the value in the put. But because of the RSI and stochastic are still overbought, I think this is on its way down to lose even more money and give me even more profitability because I have a long put. And with Google, they are announcing earnings, so implied volatility will be going up. But you can see here bullishness with the Tenkan Kijun, slightly bearish with the span. Heading towards overbought. Stochastic now is overbought. Implied volatility going down. So, it's up $12 today. Let's see where this goes. It's recovered a lot of value. It had been as low as negative 66% profitability. Now it's positive. It's in the green, $358. It had been down several thousand, so I'm happy about that. But, oh, look, up 2% for today. SPY, today the market rallied. I think that things are getting a little too hot. Tenkan way above the Kijun, that's bullish, and it's trading above the Tenkan, that's bullish. Span bearish, bearish. So you got the span B above the span A. That's a bearish sign. RSI getting pretty hot. Stochastic hot. It's overbought. Implied volatility going down. Very low implied volatility. So my last trade for today will be to do a put credit spread. I believe SPY is going down pretty soon. So do a put credit spread. And the reason we do a put credit spread, well, first I want to be bearish. Yeah, let me pause this. So what I'm going to do on this one is actually do a collar. Implied volatility is relatively low. I am going to buy a put and sell a call. I'm buying a put because implied volatility is relatively low. I'm selling a call just because the call value is very high right now. SPY is very bullish. But there's not much difference between doing that, the collar, and just doing a put credit spread. Go out a month, do the August weeklies. There it is, already ready. And we'll sell 20 delta call, and we'll buy a put a little closer to the money. But let's see what we have to do to make this a credit. So we can sell right at the money, and that's a big profit on that one, 505. And we can buy a put for quite a bit cheaper. You see the difference in price. So you can sell for $5.04, and you can buy for much less than that, like 3.76. I'm going to make it even cheaper. I'm going to buy right around the 30 delta. So there it is. Bump up the limit. It's all over the chart right now. Wow, it's really cooking. Let's see if we can get a couple of those in. And we'll do a ladder. So one more, and we'll just be a little bit more optimistic in our credit that we're seeking. Oh, see, the price has been going down. So I think we need to be a little bit more realistic to get that to hit 70. Let's make one at 272. So I want one of these to fill before the market closes, and just a matter of, just a couple dollars. It really doesn't matter. So, oh, see, the value keeps going down. I'm kind of chasing at this point. I don't want to be chasing, but I do want it to fill before the market closes in 9 minutes. Again, this is Wednesday, July 10th. So all it needs to do is just kiss that value once, and then we're good. So hopefully that'll trigger. That's all for today. I'll look at that 2.71. Let's just see if it triggers. Come on, SPY. But you see how I laddered? I got one at 2.72, 2.74, 2.78. So real optimistic. But it's getting there. It's fluctuating all around that. Just has to hit 272. Come on. Hit 2.72, and then we'll have one order in. See that 2.71? Let's see if it does it. You don't want to rush the order. And these are, just a difference of a few dollars. If you're talking about Amazon, that could be a difference of hundreds of dollars, and it still goes within those ranges within minutes. So I'll look at that. SPY. All right, so it's a 2.73 right now. One of these should be filling. Got the 2.72 working order. Now it's a 2.74. See why you don't want to just rush the orders. So these should start getting filled. There we go. See that? First one filled. Now it's a 2.75. This is why you don't want to be chasing the market, and why I didn't lower my limits to 2.69 where it had been trading. So just give it a sec. Let nature take its course, if you will. See if some of these remaining two combos get filled. And if not, then I got one in. I never like to see all my orders get filled, because then I know I could have asked for more. But it's trading all around that value now. 2.74 is where it needs to hit. It's at 2.73. So let's see. 2.74. I think if it hits 2.75 again, then that limit order will trigger. There we go. Check that out. 2 out of 3. All right, that's all for today.